Shikha Sharma, MD and CEO of Axis Bank.
Seeing things move in the right direction, we may be impatient with the pace at which some of this might be happening, but directionally I think it is moving in the right direction, and we see that in the numbers. So car sales have begun to lift a little bit. If you speak to some of the retailers, they are finding some categories beginning to lift. So I think sentiment is improving. We are seeing growth come back, and hopefully as the global economy comes back as well, there will be some export-led impact as well.
Now, at this point in time, exports continue to be a big cause of concern. They've been declining practically month on month.
That's
but
right.
In terms of the rate environment, inflation has come off and has come off quite significantly. The Reserve Bank governor says that he's going to be monitoring data to take a call on what next. But what's your own sense? And of course, he said that banks haven't fully transmitted the front loading of the cuts that's already happened. So is there scope now for a further cut from you and of course the governor?
So as far as rate cuts by RBI are concerned, I think the governor has been very lucid in talking about the issues that he's going to think about, and he is thinking about in terms of rate cut. So I don't really think I have anything more to add to that.
But do you expect one this year or not?
No, let me actually just complete what I was saying. But in terms of the transmission issue, always given the system of lending and the system of base rate, which is fundamentally about the average cost of funds for banks, transmission is going to take its time. It took time even when rates went up, and it's going to take time as rates come off. And what will help that is actually maintaining an easy liquidity situation in the marketplace. And frankly, while the rate cuts had happened, liquidity remained very tight till April or even early May of this year. And it's only after that that liquidity positions become more comfortable, and therefore the cost of funds to banks comes down, and therefore transmission will take its time. I mean, it's a natural thing, and it will happen, and I think it's some 25-30 basis points has happened already, and I would think over the next 3-4 months you would see more transmission happening by the banks. But what will help in rate reduction is both a combination of rate cut announcements, which RBI has done, but also an easier liquidity situation. And the governor talked about the fact that he's looking at reducing SLR, which will allow more credit being available to the private sector. So I think all of those steps will actually
So your
help
base
in the right
rate revision happened in June, and you're saying that over the next 3 or 4 months there is the possibility or the room for a further revision?
Actually, we had done one rate cut even before the rate cut announcement by RBI, just based on how we were seeing our cost of funds transition. And so that's really the primary driver for us, that as cost of funds come down, we would be very happy to transmit rates.
So do you believe that there is room for another rate cut from the Reserve Bank in this calendar year?
If conditions remain benign the way they are right now, we're not seeing growth pick up too much. It is moving in the right direction, but it's still kind of anemic. Inflation seems like it's trended in the right direction. The monsoons haven't been too bad, so hopefully that doesn't put much pressure on food inflation. Once the US Fed action is done with, I think that gets discounted as well. I think you will have an environment where there may be headroom for a rate cut.
Let me talk to you about the problem that the banking sector is faced with, and that is as far as stressed assets and NPLs go. And if I were to look at specifically as far as Axis is concerned, your slippages are at about 5-year highs at this point in time. You have refinanced accounts as part of the 5x25 scheme. If you could throw more color and light on what we can expect now in the coming months.
So one has to look at the fact that we've had slow growth in the economy for a couple of years, not just for a few months, but for a few years, and that obviously means that there is credit pressure which is going to come into play. And not only that, we've had an environment of low growth coupled with high inflation. So it's actually not a great environment from a credit health perspective. On top of that, we've had projects getting stuck, and therefore some of the viable projects also needing some kind of reschedulement, needing lengthening of their repayment schedules because their implementation schedules have got extended. At the same time, RBI has rightly come up with measures which have tightened asset recognition, and that has also had a corrective impact. So it's all these 3 factors which have resulted in a higher number of stressed assets coming through the banking system as a whole. I do think that at Axis Bank we feel we've done reasonably well in a tough environment, and we've been careful about how to manage risk and in differentiating between viable companies that need cash flow adjustment and maybe companies which are actually stressed and need some restructuring, either through sale of assets or getting more promoter money come in, or get equity through an external partner. So we've been working with companies and making all of that happen. And I do think that India of today is seeing promoters much more willing to take all those actions. And
but any specific sectors where you're actually seeing the promoters being able to, at this point in time, bring more equity in?
We've actually, as the markets opened up, we saw that happen with many of the highly leveraged debt groups as well. So I don't want to pick a specific group or a company, but I think we've seen it across infrastructure sector, which was the most levered. I think we saw quite a few of the companies sell assets, raise equity. So we've seen some of that action, and I think clearly the RBI's actions have helped push some of this as well.
But do you see more of your accounts going to the 5x25 route, or the ARC route, for instance, which is something that other banks are taking at this point in time?
So I think I want to make it clear about how we look at 5x25 and ARC and internal resolution. As far as 5x25 is concerned, I think it's a valid mechanism which RBI has provided for projects which might have got delayed and therefore need an extended repayment schedule, or projects which may not have been financed under the right structure initially itself. So if you have a power project, or you have even a metals project which has a life of 20-25 years, and you give it a loan of 7 years, then you are creating a cash flow mismatch. And therefore having a legitimate 5x25 scheme is a legitimate refinancing mechanism, and I don't think we should confuse it with stressed assets. So that's the way we would look at 525. That if the fundamental project has viability, has long life, and there is a mismatch in repayment schedules, then I think it's a valid case for 525, and we should look at that. As far as sale to ARCs is concerned, we would resort to that if we felt that we were not the best resolver of this asset. And actually the ARC would be able to do it better by bringing together a pool of assets. And that's the situation under which we have worked with ARCs in making it happen. Our preference is to do cash sales, so that, if we're selling it to the ARC, they pay us the cash and we kind of move on. And otherwise, we are happy to work internally in terms of working with promoters in resolving some of these assets. So we've used all the three routes and will continue to.
Okay, but speaking specifically as far as the restructured assets are concerned, and on the steel and sector in specific, because that's where we're seeing a fair amount of stress. What is your position there, and in terms of both exposure as well as resolution?
So we do have exposure to the metals sector, and that's in the public domain. I think it's just around 3%. But all of it is not steel. There is steel and there is other metals as well. And about 70% of our metals exposure is to A and above rated companies. So when you look at that 3% number, again, please don't assume that it's all stressed steel assets. And I mean, we recognize that there is situations of stress, and we're working with promoters and we're working with other bankers and trying to find resolutions for some of those stress assets.
So as we see this gradual lift-off and this gradual recovery, do you believe that the worst is behind as far as NPLs, restructured assets are concerned? Do you believe that FY16 is likely to be significantly better than FY15 on these parameters?
Yes. So, Shireen, one, from a macroeconomic perspective, as I started out, I think we're trending in the right direction. We may get impatient about the pace, but we're definitely moving in the right direction. We're seeing promoter attitudes today in terms of resolving, which are very different from what we've seen in the past. So those are both positive events that are happening. And the third is, I think RBI putting pressure on income recognition and asset recognition is making the banks work at trying to find resolutions. And I think that's, again, a good positive outcome to have achieved. So with all of this, we are clearly seeing that things are actually on the mend path. If we look at the early delinquency numbers, which is what I watch in terms of looking at the health of credit, we have been saying this for a couple of quarters now, that we think the worst is behind. And while improvement will take its time, and it's linked to as the economy improves, but we are definitely not seeing things worsening. And that's...
All right, so that's the word coming in from Shikha Sharma. There should be a lot of optimism in the future. She says the worst is behind, growth should be returning. And with that, we need to wrap up on half